Focus. Ideate. Innovate. Enable.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Planning finances for a secure future is an exercise in patience and logic. It is important, after all, for you to know what you own and why you own it. And that's where we come in. Hello and welcome to the Mutual Fund Day Family Financial Plan series, where we help you chart out the best path to reaching all your financial goals. Each episode we feature investors from different parts of India along with a financial expert to help you understand the nuts and bolts of financial planning. This episode we are in the city of Chennai to meet with Bhuvana Panchnath, our featured investor, along with her financial planner Mr. A.K. Narayan. So let's kick things off by taking a brief look at Bhuvana's financial planning journey so far.
In today's episode, we will be looking at the financial planning journey of Mrs. Bhuvana Panchnath. Bhuvana, along with her husband, runs a diagnostic firm in Chennai. It was more than a decade back that Mrs. Bhuvana took keenness towards investing in mutual funds.
I started investing about 12 years ago, whereas my husband started only about 5 years ago. The reason being, my husband wanted to invest in his own firm, whereas we wanted to invest outside, and we decided to invest in mutual funds. The only important thing was I had to discipline myself, and I had to keep saving a lot.
Since we are running our own business, initially most of the investment was in the business itself from my end, and at one stage we decided that we needed to have investment outside also, and that's where Mr. Narayan stepped in and gave us guidance. So that was around 12 years back, and initially it was my wife who did the investments in mutual funds, while I continued to invest in the company as well as putting some money aside for the education of our children. About 5 years back, I started investing in mutual funds, and again Mr. Narayan has advised me on which are the areas to invest in and how to go about it. So currently my portfolio is still quite a small one, but it's going on, and we expect it to grow in due course.
The family was never really into investments and followed the usual conventional routes like bank fixed deposits. It was only after their financial advisor, A.K. Narayan, started managing their investments that the family entered the mutual fund space. He introduced them to newer routes and modes of investments.
We used to traditionally, invest in, LICs and FDs and all. Till 2004, 2005, we decided that we'll have to explore other possibilities. And so we sought the advice of Mr. Narayan, our advisor. And at that time, I think the mutual funds had just kind of come into prominence. And he advised us around that time.
The family absolutely loves to travel and would like to have an allocation for the same in their short-term funds. Apart from that, higher education funds for both their kids is a top priority.
We definitely need to plan for our future, retirement, which will probably come in between 5 to 10 years. And definitely want to live in some kind of gated community. So we'll have to buy a property for that.
The immediate goals are the higher education for both my son and my daughter, and then of course marriage will next be the requirement. So those would be the short-term goals. Long term, we also have to now start thinking of what we want to do for retirement and what kind of needs we would have after that. So that we have to plan, but that's still some time ahead. So that's currently what we are looking at.
All right, on that note, we'll take a short break, but when we return, a detailed analysis of Bhuvna Panchnath's balance sheet with the help of a financial advisor, Mr. A.K. Narayan. Stay tuned to CNBC TV 18.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Welcome back. You're watching the Mutual Fund Day Family Financial Plan series. Now, in the previous segment, we got a broad overview of our featured investor, Bhuvna Panchnath's financial planning journey. In this segment, we'll be taking a deep dive into her investments and goals and see how things work out, along with the help of her financial advisor, Mr. A.K. Narayan. So let's start the discussion with you, Bhuvna. Your journey into investing in mutual funds started 12 years ago, but there was a significant lag with your husband's start of this journey. Why so?
To begin with, we actually run a firm, and we are both actively involved in it. And we decided that my husband would invest more in the firm, and I would go into the mutual funds. And I have been greatly influenced by my advisor, and he kind of led us through the path. And that's it. So we feel that my delving into the mutual fund would be of far greater importance, and he would invest more in the firm. That was our reason.
So are you comfortable with this balance?
It does look kind of risky, but to tell you the fact that we, as a firm, we need a lot of funds for our business. So the debt is, taken care of in that field. And we decided that we would, go in more into equity as far as the mutual funds are concerned.
Okay. And how do you characterize your risk profile? You run a business, so your risk appetite might be higher than average. But when it comes to investments, how would you characterize your risk profile?
I don't think it is very great, because we greatly trust the financial advisor, and all the advice that he gives is to our interest. So I would say that we are not at risk at all.
Now, fixed deposits constitute around 10% of your portfolio. Now, looking at the new normal of low interest rates on these deposits, are you planning to shift some of this portfolio from FDs to, say, debt funds or even FMPs?
We would do that eventually, maybe shift a lot more that we have invested in the company. We would be shifting that to the equity.
Okay. Now, coming to you, Mr. Narayan, you've advised the couple since the start of their investment planning journey. How would you characterize the progression of their portfolio and its performance so far?
To tell you very frankly, when I started interacting with Mrs. Bhuvna and asking her to invest money in the equity funds of the mutual fund, I used to tell her that, to get a decent return, which I always define as inflation plus some kind of return. Even today, I would think that bulk of our investments come through by way of SIPs, and now and then when she gets some bonus or some kind of an ad hoc amount, she always used to call me and say, where can I put my money? And those kind of money will go to either balance fund or some kind of a debt fund to begin with, and ultimately it will go slowly but steadily into equity fund.
But the largest investment in their portfolio is in their own business. Isn't that risky? What would you advise to other small business owner out there watching this show, and how they balance the need to grow their business versus the need to grow their private wealth?
See, there are two aspects to this. One is the family assets, and second is the business assets. So if somebody running a business, he always like to put money into the business, because the business always needs money. Irrespective of what you want, the business always keeps in demand the money. So I always tell the promoters that certain amount has to be put outside the business group, so that the diversification starts. So that is why this systematic investment plan of mutual fund helps those kind of promoters. And I always urge the business people to set apart some amount on a monthly basis, so that some kind of a diversification takes place and risk mitigation exercise also falls part.
All right. Bhumna, what kind of emergency funds have you provisioned for?
Some of it is in liquid funds, which we would be able to liquidate. And in the extreme emergency, we just run back to the firm and take some.
All right. Mr. Narayan, what would you advise to small business owners watching this show on how to go about creating an emergency fund? What are the do's and don'ts?
Yeah, generally the liquid funds are the best part. Whether you like it or not, the liquid funds definitely give you a superior return to savings bank account. So at least 3 to 4 months of your expenses, I would think that it should be placed in a good liquid fund, wherein in case of emergency, you can always take out the money in 24-hour notice. So that is the starting point for any businessman to keep their money in a liquid.
Right. I have a follow-up to that. Now, you mentioned investing in mutual funds via SIPs, but a lot of business owners, their incomes fluctuate. So how should they go about approaching this route to investment, since their incomes do fluctuate on a monthly or a yearly basis?
See, the businessmen also, if you look at it, there are two varieties of businessmen. One is depending totally on the business profits and loss account, and second is some people who derive regular salaries and wages from the business. So in this category, I would think all businessmen should derive some amount of fixed income on a regular basis, so that can be taken care of their expenses, as well as certain portion can go into the saving. I always feel 10 to 15% of their income on a monthly basis should go into SIPs to begin with, so that they can build a corpus to reach their goals.
All right. Now, Bhuvna, earlier you were part of a joint family where expenses were shared. Then you and your husband and your children started living separately, where the expenses doubled. So how did you transition your financial planning to this new normal?
Well, we knew that once we started living separately, our requirements would be a lot more than what used to happen earlier. And we took a careful decision and said that we'll have to invest a little more and make sure that our savings were a lot higher than what it was. And we also inculcated this habit in our children. And as my father used to say, he was like a sparrow, always trying to save. So I think somewhere that has got into me. And we wanted our children to do that. So it was a conscious decision that although our expenses would double, we would have to invest more and make sure that we saved more.
All right. Now, when there is such a sudden change in terms of the finances, in terms of expenses, how should an investor look about assessing their portfolio in terms of adjusting it according to this new, say, substantial change in finance?
See, what happens, as you say, many cases they come to us and say, my income has suddenly stopped, or it has reduced, or a job loss, or some business has not done that well, or my debts have gone up. All kinds of things keep coming. But my advice to them is, they can always pitch in and derive some money out of their savings, past savings also, by means of systematic withdrawal plan, in case they want to tide over the immediate difficulties. That is one step they can do. Second, in case they feel that the continuity of the income is going to suffer for longer duration, then they will slow down a little bit on a systematic investment plan for the time being, and then they can restart it once this income stabilizes. That is the second part of it. And third, they should also look at high debt oriented loans which they have taken to pay off, so that their income can stabilize. Many people have taken high price loan, whether it is a personal loan or two-wheeler loan or four-wheeler loan or housing loan or whatever it is. They have to reduce their loan whenever their income stream is going to reduce, or they're going to face some kind of difficulty when the income stream is going to come down.
All right, on that note, let's take a quick break on the Mutual Fund Day Family Financial Plan series, but we'll return with lots more to discuss with Bhuvna and Mr. A.K. Narayan. Stay tuned to CNBC TV 18.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Welcome back. You're watching the Mutual Fund Day Family Financial Plan series. We are on the final leg of this episode along with Bhuvna Panchnath from the city of Chennai and Mr. A.K. Narayan, her financial advisor. Now, Bhuvna, you invested in LIC policies. Most of them have matured. How are you taking care of your insurance needs now?
Frankly, to tell you, when I have attended a lot of investor awareness meets, I did come to understand that insurance doesn't give you a lot of return. So we decided that we would no longer invest in insurance policies. So I don't think we foresee any problem.
Which makes sense. It keeps your mind at ease in terms of preparing for the worst. Now, speaking of that, Mr. Narayan, small business owners do have a lot of risk appetite in preparing for the worst, but what's the ideal strategy in terms of insurance needs and how they can prepare for the worst?
See, the insurance, I always say that term insurance policy is the best for anybody, and that is a must, because the breadwinner, in case something happens to him, the family should not come to the roads. That is the principle of the insurance. But here what happens in the last 5-10 years, if you look at what happened in Indian market, a lot of people have taken ULIP policies and various other policies, not knowing the real intention behind those policies, and ultimately they feel a little disappointed. So my feeling is that term policy is the best for the businessman, and apart from the term policy covering their life, they should also make sure that personal accident policy and also health cover is a must for everybody today. The cost of health is going up day by day, so definitely they must have the health cover in place.
Alright, and shifting focus, take us through the tax planning of their investments.
See, I basically tell people that first of all, that 1.5 lakhs, whatever we are covered under ATC, should be definitely taken care of by means of investing in a good ELSS, equity linked savings scheme. Now, many people come back to me and say, I've already exhausted my PF, PPF and all that. But irrespective of anything, in case your intention is good to stay longer term, it is better to put some money in a ELSS fund, which automatically takes care of your tax planning on a longer duration. It serves two ways. One, you don't like to touch the money for at least 3 to 4 years, because 3 years is compulsory lock-in period. And secondly, the returns are quite reasonable as compared to many of the debt schemes which has come in between. So 12 to 13%, which I always mention, which is always derivable by means of putting money in a good ELSS fund.
Alright. Now, Bhuvna, gold is around 5% of your portfolio, but you've stopped adding to the tally. So what's your plan here in terms of the amount already invested?
My daughter's about 21, and maybe when my son marries, I would just kind of give away most of what I have, because I don't think the gold returns are very good at all. So I am not going to invest much in gold.
Okay, let's focus on your long-term goals now, starting with the education of your 2 children. Now, your daughter has already graduated, son is a few years away from graduating. What's the corpus size that you have targeted to fund their further studies, and how do you plan to go about achieving that, or how close are you to achieving that?
We are still a long way, to achieving the corpus size, but definitely we will need about 20 to 30 lakhs for furthering the education of my daughter and my son. And my daughter, although she's working, she is planning to study further. Okay. And the same holds for my son as well. So we do think we need to save a lot more to make sure that we are able to help them completely. And the other thing I've told my daughter is whatever she earns, she has to put a sizable amount away to take care of her education as well. So it's going to be a joint thing between parents and the child.
Right. Now, in this instance where there is still a long way to go to meeting the target, but say there is immediacy in generating those funds, how should one go about planning their investments or rebalancing their investments to achieve their education fund goals?
Yeah. Normally this goal-based investing helps you in this also. Suppose the education of your daughter or son is for 4 years away or 5 years away. So you should start investing right away so that you can aim to build a sizable corpus. And then, if the 50% or 60% of the amount aimed at for higher education is you are able to derive from this corpus, you can always look at a little bit of educational loan to pitch in and then make good for the balance amount. So it has to be a little bit of borrowing, and make sure that the children are also responsible for paying back that money. The parents should not be held responsible for paying back the debts borrowed on account of education loan. This is what I always used to tell people. So they have to be accountable for that. And like what Ms. Bhuvana was telling you, that the daughter already earning money, and she's also contributing on a monthly basis for our corpus as well. So that will also come in handy whenever she decides to go abroad or whenever she decides to make further studies.
Okay, let's come to our final question, Bhuvana. What lessons have you learned in your 12-year investment journey that you would like to share with our viewers?
I think one has to be really, really very disciplined as far as financial planning is concerned, and one has to learn more. There's so much, available in the market. There's so many awareness programs. You've got to learn and imbibe so much from that. And personally, I feel you should inculcate these habits in children, and I take my children, a lot of my friends, to the awareness meets to make them understand that what was the traditional kind of saving is no longer really good for us.
Okay, and Mr. Narayan, what would be your summary statement to small business owners watching this show, their approach, their queries, their doubts about financial planning? Where does it all begin? Where does it all end?
I think financial planning is a serious subject. It cannot be taken lightly. One has to spend time to learn things. Like what Ms. Bhuvana was saying, you have to attend investor awareness program whenever you find time, and you will be able to get some kind of new ideas every time you attend the program, and you have to enrich your knowledge, and ultimately you have to pass it on to your children and try to make use of those kind of ideas which gets out of those awareness programs. And you have no other methodology of creating wealth excepting saving and putting that saving to work in a proper instrument. And mutual fund, in my opinion, helps you to grow your wealth.
All right, with that, it's a wrap on today's episode of Mutual Fund Day Family Financial Plan series. I'd like to thank our guests for sharing with us their valuable lessons and insights on money management, and thank you to our viewers for tuning in. Catch the next episode of this series where we'll be coming up with more insights, more lessons on financial planning and, of course, money management. Stay tuned to CNBC TV 18.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Focus. Ideate. Innovate. Enable.